Hello everyone, this is Gracie here. So we will be continuing with the next IFRS standard, which is IFRS 4 insurance contract. So IFRS 4 is the first standard dealing with insurance contracts. It defines the rules of financial reporting for insurance contracts, including reinsurance contracts by entity who issues such contract, that is insurer, for example an insurance company, and for also reinsurance contract by entity who holds them. So note, IFRS 4 does not apply to other assets and liabilities of an insurer. Also IFRS 4 does not apply to policy holders. So any firm which is engaged in providing insurance or which is dealing with insurance activities, then you need to adopt insurance contract standard. You need to follow the guidelines provided in IFRS 4, which is insurance contract, to follow the insurance processes. How are you going to account it? So this IFRS standards is applicable to the company or entity which is dealing with insurance contracts. So they've clearly explained here, they've given a note here, IFRS does not apply to other assets and liabilities of an insurer. It does not apply to any other assets and liabilities of insurer, and it does not apply to policy holder. So it is policy holder insured entities. So it is only for insured entities, or it does not apply for the policy holders. Next, IFRS 4 defines insurance contracts and establishes accounting policies applied to them, including recognition and measurement rules. It addresses some specific issues such as embedded derivatives in insurance contracts, situations when insurance contracts contains both insurance and deposit components, example, some type of life insurance with capital part, shadow accounting practices, etc. So this paragraph explains that insurance contract, IFRS 4 defines the insurance contract and establishes accounting policies applied to them, including recognition and measurement rules. Yes, what this IFRS 4 tells you all is, it clearly explains what is an insurance contract. It defines what is an actual insurance contract entity and what is its business, and it establishes the policies, that is accounting policies, to be implemented, including how are you going to recognize whether it is a valid insurance, and how are you going to measure the insurance policies, how are you going to recognize and measure different kinds of insurance policies, and how are you going to account it in your statement. And it also addresses some specific issues such as embedded derivatives. So on what kind of commodities, on what kind of subject or specific subject you can take insurance policies. So such as embedded derivatives in insurance contract, that is fixed commodities, currencies, or securities on what are the accounting policies to be followed when the insurance is imposed on such derivatives. The standard explains what are the guidelines or procedures or policies to be followed when you are engaged in embedded derivatives in your insurance contracts, and also situations when insurance contract contains both insurance and deposit component. So now all the insurance company does not only engage in providing insurance, it also engages in receiving deposits, like example, some type of life insurance with capital part. So when it is both issuing insurance as well as deposit component, then shadow accounting practices can be followed. What is shadow accounting is, I have written here the explanation. Two separate sets of financial books are recorded for the purpose of detecting mistakes. Yes, when both are engaged together, when the insurance company is engaged both in deposits as well as insurance rendering insurance services, it needs to maintain two different sets of accounts. So in order to avoid the mistakes. So when the insurance company is engaged in both, it is difficult to identify. So when you use shadow accounting policy practices, it will clearly help you to maintain two separate sets of financial books for detecting mistakes. So this is your IFRS 4. It also discusses discretionary participation feature in insurance contract or financial instruments, contracts in which exception for a guaranteed element policyholder is entitled to a profit share whose timing and or amount at the insurer's discretion. So discretionary participation is apart from insurance co-investing with help of brokers. So insurance companies provides you deposit services as well as insurance services. After that, including that, they provide investment services also. That is nothing but brokers, like insurance brokers helps you all to decide which investment sector will give back good returns. So when they are engaged in that also, their what are the procedures to be followed, IFRS standard 4 clearly explains here. IFRS 5, non-current assets held for sale and discontinued operation. So IFRS 5 specifies the accounting for assets or disposable groups held for sale, those whose carrying amount will be recovered principally through a sale transaction rather than continuing use. So here this accounting standards helps how to treat the non-current asset which is held for sale. The asset which is held for sale is which is kept as it is, where there is nothing recovered out of the asset, and which is kept where depreciation is not charged on these assets. Only an asset depreciation will be charged when it is used for use into the activity. If it is held for sale or which is kept idle, depreciation on it is not charged unless and until it is implemented in the business activity. So such assets which is held for sale, which would be recovered, recovering such asset will give you the principal amount rather than keeping it for continuing use. That is why such assets are kept which are held for sale. How are you going to treat such asset which is kept or which is held for sale, where future it doesn't give, it will not bring any profit? So it is better to recover it with principal amount immediately instead of continuing the use. And discontinued operations, and the activities where the line of operation or the business operation where the entity's components are discontinued, like subsidiaries performance, line of business activity, geographical area of operations, etc., that either has been disposed or is classified as held for sale. So the assets which are kept, which are held for sale, as well as discontinued operations activities, how are you going to account in your accounting statement? So this IFRS 5 explains the methods and policies to accounting policies to be maintained. So in relation to assets or disposable group held for sale, IFRS 5 establishes condition when the entity shall classify a non-current asset or a disposable group as held for sale. So the standard explains what how an entity should classify a non-current asset or a disposable group which is held for sale. Then it sets up the rules for measurement of assets or disposable groups held for sale. So what it sets, it sets rules for how to measure such assets. That is the value of how to measure such fixed assets which is held for sale. Next, recognition. So when will the what recognition, in the sense how are you going to measure it, what is the worth of it? Recognition of impairment losses. Here impairment losses means the loss where you don't get profit out of such assets. Impairment loss, where the sale of the asset will get you the value of the asset, that is the exact value of the asset, or either it will reduce the cost of the asset, where when such asset is being sold in the market, you don't get profit out of it. It is an impairment loss where the asset doesn't give you any profit, where it is the value of it is already reduced in the market. So recognition of impairment loss and their reversals and rules for the situation when an entity makes changes to a plan of sale and asset or disposable group can no longer be classified as held for sale. So how are you going to measure such assets which is a group which is held for sale, and recognition of impairment losses and the rules for situation when an entity makes changes to plan to plan of sale or to dispose, or disposable group can no longer be classified as held for sale. How are you going to treat the assets which is held for sale or which is held for disposable operations, and which is then how are you going to treat which can no longer be classified as held for sale? How are you going to treat that as such assets which is there in your business? So next, in relation to presenting discontinued operation, IFRS 5 explains the term discontinued operation and prescribes what shall be reported in the statement of comprehensive income and statement of cash flow with regard to it. Additional disclosures in the notes to the financial statements are also required. So here discontinued operations in the sense the activity which is not carried forward, which is stopped, the activity or the business activity which has stopped, might be in the subsidiary company, might be in different geographical areas or different branches where you set up the operations which are continuing and suddenly stopped. How are you going to treat such operations where it's already generated certain income and now the operation has been discontinued? So when such any profit or any loss which is incurred from that discontinued operation, how are you going to show it? So how are you going to show it? You will bring out the balance in your cash flow. If any cash flow is remaining in that discontinued operation, you would have you can show it in the statement of cash flow and in your comprehensive income statement. But you need to also mention what is such income. How is such income brought into your income statement and cash flow statement? You need to disclose that information in your notes to accounts. Notes to accounts is nothing where you theoretically explain what is the exact value or the figure which you have shown in your financial statement. You will theoretically explain in your notes to financial statements. So IFRS 5 mainly deals with your non-current assets which you have held for sale. How are you going to treat that asset in your business? How are you going to treat it? Where are you going to place? How are you going to measure it? Measure the asset. That is, how are you going to measure the asset which is held for sale, and how are you going to recognize the impairment losses? Then your discontinued operation. So how are you going to treat your discontinued operation is nothing but by disclosing the information or any brought downs carried forwards, such information to theoretically explain, and it should be disclosed in your notes to your accounts in your financial statement. So next is exploration for and evaluation of mineral resources. So IFRS 6 specifies financial reporting of the expenditures for the exploration for and evaluation of mineral resources, that are mineral oils, natural gas and similar non-regenerative resources. So activities like where the activities, business entities which are engaged in evaluation or which are engaged in mineral activities, that is mineral resources like mining. So when you are engaged in such activities, you need to follow the guidelines or the principles, the rules which is laid down in IFRS 6. This IFRS 6 helps the entity which are engaged in mineral resources activities. So let's look into it. What kind of that are minerals, oils, natural gas and similar non-regenerative resources. So non-regenerative resources in the sense your coal, gas, oil. So IFRS 6 prescribes that exploration and evaluation assets shall be measured at cost. It permits the entity to determine accounting policies specifying which expenditures are recognized as exploration and evaluation assets, and gives an example of acceptable types of expenditures: acquisition of rights to explore, exploratory drilling, trenching, sampling, etc. So here when it is evaluation of mineral resources, you can't take all kind of activities like exploring or evaluating all kind of resources in IFRS 6. It clearly tells you all what kind of mineral resources can be accounted in your financial statement and when can you use, for what kind of resources you can use IFRS 6 standards. So that is what it states here. Prescribes that exploration and evaluation assets shall be measured at cost. It will always be measured at cost. So that is evaluation and exploration. That is evaluation. How are you going to measure the worth of the asset, that is worth of the mineral, as well as exploration. Exploration is the mining activity. So everything will be measured based on the cost. It permits the entity to determine accounting policies, specifies which expenditures are recognized as exploration and evaluation assets, and gives example of acceptable types of expenditure. See, all exploration and evaluation, or for example all mining activities, cannot be considered into your financial statement. What kind of expenses can be considered? IFRS 6 gives a detail of it. So they've given here acquisition of rights to explore, exploratory drilling, trenching, sampling, etc. All such kind of expenses can be considered or is acceptable in IFRS 6 if the entity is engaged in evaluation of exploration and evaluation of mineral resources, like acquisition of rights to explore, exploratory drilling, trenching, sampling, etc. IFRS 6 then prescribes the rules for subsequent measurement, changes in accounting policies, and impairment of these assets. The impairment rules related to the mineral resources differ from those in IAS 36, as they set the different impairment indicators and allow testings on an aggregate level. In relation to presentation, IFRS 6 describes classification and reclassification of exploration and evaluation assets, and finally number of disclosures in prescribed. This exploration for evaluation of mineral resources also states, apart from determining what are the expenditures and what are the changes to be made for while accounting these business entities activities, irrespective of evaluating mineral resources, they also state that changes in accounting policies and impairment of these assets. That is, when a business organization is into mineral mining or mineral resource activities, when they are engaged into it, their accounting treatment will vary. So when their accounting treatment varies, IFRS 6 gives them a guideline, and they state that all the expenditures which are engaged in exploration and evaluation of such assets will not be considered. Only certain expenses will be considered. That is, from acquisition rights to like they've given here, acquisition rights to explore, exploratory drilling, trenching, sampling, etc. Only certain expenses will be considered under this evaluation of mineral resources. Next, here it also states that it also measures impairment of assets. That is, impairment here, it also gives the rules to maintain the impairment losses or impairment asset treatment in this IFRS 6. What do you mean by impairment? In the sense where the value of the asset is reduced, where the book value of the asset is less than the market the market value of the asset is less. So where the asset's worth is reduced, no more the asset will no more bring any income. Such assets are called as impairment of assets. It usually gets losses, impairment losses. The sale of the asset will only get loss, or the exact value will be regained. No profit will be generated from such assets. So how these assets should be treated, how these assets should be accounted in your when you are engaging your business in evaluation and exploration of mineral resources. The impairment rules related to the mineral resources differ from those as in IAS 36, as they set the different impairment indicators and allows testing on aggregate level. Yes. So how these impairment assets can be finded is, every minerals will not have the same worth. Like for example, the soil worth is different from different soils, isn't it? Different soil has different features. In the same way, every minerals will not have the good features in it. So a testing procedure is gone through in order to test whether that particular mineral or that particular asset is impairment or what. Based on the aggregate level, the testing procedures will be taken, and based on that testing procedure, certain percentage of variation will be be done, and those variation will be accordingly accounted in your financial statement. How is it being accounted? With the help of IFRS 6, which states what kind of minerals, what kind of natural gas, what kind of non-regenerative resources can be accounted, what in those resources how many are impairment, what is a percentage to be accounted, will be explained.